$300 trillion. That's roughly how much debt exists in the world right now. Not money, debt. If every country, company, and household tried to pay it all back tomorrow, the global financial system would collapse before lunch, which raises a strange question. If debt is supposed to be temporary, why does it keep growing forever? And more importantly, if the world can't escape debt, who actually benefits from that? Because someone clearly does. For most of human history, debt was something people feared. In ancient Mesopotamia, if you couldn't repay what you owed, you didn't just lose money, you could lose your land, your freedom, sometimes your family. Rulers periodically erased debts entirely. They called these debt jubilees, a reset button, because leaders understood something simple. If everyone is buried in debt, eventually the system stops working. But the modern financial system works very differently. Today, debt isn't just a risk, it's the engine.
Let's start with a simple question. Where does money actually come from? Most people imagine governments printing it, but in modern economies, most money isn't printed. It's created by banks, and they create it through debt. Here's how. You walk into a bank and borrow $10,000. The bank doesn't reach into a vault and hand you someone else's cash. Instead, it creates a new deposit in your account. That deposit becomes money you can spend. In other words, your debt becomes someone else's money. This is called credit creation, and it's the foundation of the entire financial system. Now scale that process up. Households borrow for homes. Companies borrow to expand. Governments borrow to fund budgets. Banks keep issuing loans, and every new loan creates new money. The economy grows, spending increases, asset prices rise. Everything looks healthy, but there's a catch hiding in the math. When a bank creates a $10,000 loan, it doesn't just expect $10,000 back, it expects interest.
Maybe $12,000 over time, but here's the strange part. The extra $2,000 in interest was never created. Only the original $10,000 entered the economy. So where does the additional money come from? From new debt. Someone else has to borrow more money somewhere in the system, which creates new deposits, which help pay the interest on existing loans. The system doesn't just tolerate expanding debt, it requires it. Think of it like riding a bicycle. As long as the pedals keep turning, everything moves forward. But the moment the system slows down, debt becomes heavier, defaults begin, banks panic, credit tightens, and suddenly the entire machine starts shaking. We've seen this before. In 2008, the global financial system nearly collapsed, not because people suddenly stopped believing in money, but because the debt cycle stalled. For years before the crisis, cheap credit fueled massive borrowing, mortgages, corporate loans, complex financial products built on top of them. Debt layered on debt. Then housing prices stopped rising. Borrowers started defaulting. Banks realized the assets backing trillions of dollars in loans weren't worth what they thought. Credit froze. Within weeks, the global financial system was on the edge of failure. Governments stepped in. Central banks cut interest rates to near zero. They injected trillions into financial markets. And the message was clear. The system must keep moving. Debt must keep expanding. This leads to an uncomfortable truth. In a debt-based financial system, growth is not optional. It's mandatory. Because if incomes, asset prices, and economic activity stop rising, existing debts become impossible to service, which is why economic slowdowns feel so dangerous. Not because growth is inherently good, but because the system is built on the assumption that tomorrow will always be bigger than today. But here's where the incentives get interesting. Not everyone experiences debt the same way.
For many households, debt is a burden. Credit cards, student loans, mortgages stretching over decades. But for large financial institutions and wealthy investors, debt can be a powerful tool because debt allows them to control assets far larger than their own money. It's called leverage. Imagine buying a $10 million building with only $1 million of your own cash, the rest borrowed. If the property value rises to $12 million, the gain isn't 20%, it's closer to 200% on your original investment. Debt magnifies outcomes, both good and bad. But when asset prices keep rising, those who can access the largest amounts of credit often benefit the most. And access to cheap credit is not evenly distributed. Large corporations borrow at very low interest rates. Governments can issue bonds backed by entire economies. Major financial institutions can access central bank liquidity in times of crisis. But small businesses and individuals often borrow at much higher costs.
In other words, the system creates money through debt. But the terms of that debt vary dramatically depending on your position inside the system. This leads to another strange pattern. During financial crises, the system rarely reduces debt overall. Instead, it shifts it. Private debt often becomes public debt. Governments bail out banks. Central banks absorb financial assets. Balance sheets move around. But the total amount of debt in the system usually grows even larger afterward. Look at the numbers. Before the 2008 financial crisis, global debt was about $170 trillion. Today, it's over $300 trillion. Not because policymakers ignored the problem, but because reducing debt on a large scale can trigger economic collapse. So the system chooses the alternative: manage the debt, roll it forward, extend the timeline, lower interest rates, create new credit, repeat. This creates a strange contradiction. Politicians often talk about paying down debt, balancing budgets, living within means. But the global financial system quietly relies on the opposite: continuous borrowing, continuous expansion, continuous refinancing. Debt isn't an accident, it's infrastructure. And this is where the long-term risks begin to emerge, because a system that requires ever-growing debt eventually runs into limits. Interest rates can only fall so far. Asset prices cannot rise forever. Demographics change, growth slows. And when the system becomes saturated with debt, small shocks can trigger very large consequences. Japan has been living with this reality for decades. Government debt there exceeds 250% of its entire economy. Yet the system continues operating because central banks, investors, and institutions have adapted around the debt. They've learned to live with it, manage it, extend it indefinitely, which raises an unsettling possibility. Maybe the world never actually escapes debt. Maybe the goal of the system isn't to eliminate it, but to stabilize it.
Stretch it across generations, roll it forward endlessly, like a financial horizon that keeps moving further away. But there's still one question left. If debt keeps expanding faster than the real economy, if growth slows, if interest rates rise again in the future, what happens when the system finally reaches the point where it can't add more debt fast enough to support the old debt? Because history suggests that moment eventually arrives. The only uncertainty is when.